Hello everybody, welcome to the webinar. Today we're doing something different. We'll talk about trading the news. We'll discuss 5 points about trading the news. The webinar is brought to you by OctaFX, an award-winning broker that has one of the lowest spreads in the industry. Okay, let's begin with a quick risk disclaimer. Trading foreign exchange carries on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. Okay, and a hypothetical trading disclaimer: all the information in this webinar is provided as general market commentary and does not constitute investment advice. Okay, and a quick introduction about myself before I begin. My name is Yohay Elam. I'm a Forex analyst. I used to be a retail trader and a computer programmer, and I founded Forex Crunch back in 2008. And the site focuses on fundamental analysis, and that's what we'll do today. So, trading the news. Let's kick it off. Our 5 points today are, well, how fundamentals move markets, and these are trading the news, understanding what is priced in and what is not priced in, expectations, identifying weak currencies through news events, combining fundamental analysis to identify false breaks. So here we combine fundamental analysis with technical analysis. And our last point for today is a classic news pattern by the rumour, sell the fact, with its different quirks. Okay, so point number 1, fundamental analysis. Fundamentals make the long-term moves, okay? So if you see the US dollar moving up or moving down, the wider trend, when you zoom out, when you move out from the 1 minute chart, 15-minute chart to the wider daily charts, weekly charts, monthly charts, the fundamentals make the big moves. Technical analysis is useful for entry points. Where exactly do you enter the market? Where do you leave? That depends a bit more on technical analysis, and that's where you can combine things. In general, when we have tighter monetary policy, we'll discuss that, then we have a stronger currency. When we have looser monetary policy, we have a weaker currency. And of course, it's built on expectations. So what is a tighter monetary policy? When you hear these terms, well, when the economy in general is growing, then employment is rising, more people are at work, less unemployment, and inflation is rising. So interest rates are expected to rise. And when the central bank raises interest rates, it wants to push inflation lower, to cool the economy, to push demand lower. And when we have a higher interest rate, for example, now in the United States, it attracts more money from outside that wants to deposit money. That if an investor wants to grow the money in a very safe way, the best way is with deposits with interest rates. So apart from interest rates, we also had, during the financial crisis, we had, it's still going on in Europe and in Japan, not anymore in the United States, money printing called quantitative easing. The central bank creates money out of thin air and buys bonds in order to depress long-term interest rates. But in general, what we need to know about it is when we have less money printing, okay, then we have less money and it is worth more. Anything that there is less of is just worth more. That's basic economics. And the currency strengthens. So tighter monetary policy, good economy, interest rates are going up, less money is printed, money is worth more, the currency is worth more, the currency rises. The mirror image of that is looser monetary policy, and that is when the economy is slowing, okay, falling, either growing at a slower rate, a very depressing rate, or actually contracting, squeezing. The total value of the economy is weaker, okay? In this case, the unemployment rate is rising and inflation is falling, because if there is less money in the economy, people are out of work, they buy less things, and prices also fall. So in this case, the central bank does the other way around, looser monetary policy. It lowers interest rates. That means that now it's cheaper to buy stuff, okay? And maybe inflation will pick up, maybe businesses will take out more loans and revive the economy, okay? central bank in general works against the trend to stabilize things. So when you have lower interest rates, we have less money coming from outside. And in the worst conditions that we had in the crisis, we had money printing. Again, the idea was to lower long-term interest rates, but in general, what we need to know, the outcome is when we have more of something, it is worth less, okay? And the currency weakens. So looser monetary policy, falling interest rates, weaker economy, and a weaker currency, okay? So that's our first point, just to know these are the fundamentals that move markets. When things are getting better, the currency strengthens. When things are getting worse, the currency weakens. But it depends on what the central bank thinks about the economy. Okay, the second point is trying to understand what is priced in. So this is a screenshot I took from the OctaFX economic calendar, okay? And you can see here expectations. For example, you can see here when you see various events at the same time, okay? So we have, for example, this is from tomorrow, from Thursday, but it's relevant for any event. This is just an example that happens all the time. You have events, you can see here the red mark indicates that the event is more important, okay? So it's GDP, gross domestic product, annualized. It's more important than continuing jobless claims, initial jobless claims, okay? So this is the main event. The other ones usually should be ignored, okay? And here are the expectations. So in this case, the most important event, GDP is expected to remain unchanged at 1.2%. So that's sort of the basic 101, what is priced in. But and it is based on the consensus of economists. It's available on all calendars. There are some differences between economic calendars, but we should understand what is important and how the figure comes out in relation to the expectations. Okay? But this is not the only thing. Expectations can change. So what you see in the economic calendar is usually relevant, but sometimes previous events feed into new events. So, for example, if we have German inflation is released and it's weaker than expected, then the revised the expectations for the all Eurozone figures are a bit lower because we already know that the biggest country printed worse outcome. Okay? Another example, we have every first Friday of the month, the non-farm payrolls, the official non-farm payrolls comes out on Friday, and we have a private sector report from ADP coming out on Wednesday, also for the number of jobs. And if it comes out, again, my examples here are negative, weaker than expected, then the expectations for the release on Friday are also lower. So expectations can change. Okay? And of course, there are always rumors running around, okay? So the whisper numbers, you'll hear these kind of terms. So expectations are not always what you see in the calendar. So you should follow the news, especially in these kind of events that build on previous ones. Okay? And of course, not all rumors are true. This is not a surprise, I assume. So take all the rumors, of course, with a big grain of salt. Okay. What happens 1 hour before the release? Price action is quite telling. So if you see some kind of price action before the release, you can learn things from it. It shows that rumors or previous figures or anything else changed the expectations, okay? Because you see action before the release. That means if it's an important release, usually you don't see a lot of movement. You see tension. You see very choppy trading, but in a very narrow range. But if you see a big move before the release, the reaction to the news could be weaker because markets basically have already moved, okay? So you can have even the opposite effect. We'll discuss that in the last point, buy the rumor, sell the fact. Okay, so again, understanding what is priced in, basically look at the economic calendar. But remember, if it's an event that is built on other events, you should also understand that expectations may have changed and watch out for the price action before the release. If markets are already moving, then the reaction to the news could be weaker. Again, usually what we have is tension, and the reaction is after the news. Okay? Our third point for today is identifying strength. Okay? What is a strong currency? What is a weak currency? The reaction to the news can give us information for further news events. Okay? And can provide also insights for technical analysis. So, news events can tell us a lot, of course. Where did it go? Okay. Basically, what is a strong currency? A strong currency jumps on a small beat of expectations. So in the example we had before, US GDP, gross domestic product, is expected to remain unchanged at 1.2%. If it changes from 1.2% to 1.3% and the US dollar jumps a lot, okay, that shows us that the US dollar is strong. Okay, that's a strong currency also ignores bad data. So if we have, instead of 1.2%, we have only 0.5%. Okay, really bad news for the US economy, for the US dollar, for the central bank, and the US dollar doesn't fall, then we can understand, okay, the US dollar is a strong currency. Okay, using the exact same example. Weak currency is the exact opposite. It crashes on a small miss. So again, using the GDP, if we have a small change from 1.2 to 1.1 or 1%, again, a small disappointment, but nothing that will really change the direction of the central bank and the currency, but we still see the US dollar falling a lot on that. That also tells us that the currency is weak, that the US dollar is vulnerable. Okay? And of course, the last case in this example, a weak currency ignores good data. So if we have tomorrow an upgrade from 1.2 to 1.7 to 2%, very strong growth in the United States, contrary to what we knew, very positive surprise, and the US dollar does not rise, that is also telling us that US dollar is weak, okay, that it doesn't respond positively to positive data. All right. More about strength and weakness. Let's give another example. Again, we'll take US data, but this is an example for everything. So we have a US release and the data is weak. Okay? But now we're not talking about the US dollar. The US dollar, okay, will fall. That makes sense. We have the data came out worse than expected and the US dollar will fall. But how much? The reaction, again, can be telling. Okay, so if it, again, this is a general idea about strength and weakness. If it falls a lot, it can be telling that the currency is weak. If it falls just a bit, it's not that weak. But let's look at, now we have a weak US figure in this example, but we're not talking only about the reaction in the US dollar in general. Let's look at specific currencies. So again, we have US releases important data. The data is worse than expected. Okay? And what do we see in this example? Again, a theoretical one. That the euro dollar rallies and the Australian dollar against the US dollar is stuck, is not going fast. Okay? So euro dollar takes advantage of the weak data, but the Aussie does not. Okay? So, and this is very common that we see split reaction between various currency pairs. So this tells us that the euro is a strong currency, is now enjoying some momentum, some strength, and the Australian dollar is suffering from some kind of weakness. Okay? And the question is, okay, we learned this, we observed markets, we didn't trade this example. How can we apply this in our future trading? So one option is next time we have a weak US release, we'll buy euro dollar. That means repeating what we've seen. Okay, so then if we're talking tomorrow we have GDP, next week non-farm payrolls, next time, assuming that this pattern continues, we'll have a miss on US non-farm payrolls, we can buy euro dollar because the euro has momentum. Okay, the euro has the strength. Another option, if we have for a change some strong US data, we can sell Aussie dollar, because we've observed already that the Australian dollar is a weak currency. Again, in our example, I'm not talking about current events. Okay, let's take another look at strength and weakness and how we can apply it. Okay, again, we have the same example. We have a weak figure coming out of the US, disappointing one, should be bad for the US dollar. And again, we're seeing euro dollar is rallying and the Australian dollar is stuck. So we talked before about how it shows us the strength of the euro and the weakness of the Aussie. We can take it this time to a different direction. Instead of trading US event, we can look at European event. So the next time we have a release in the Eurozone that is just okay, doesn't need to be extraordinary, doesn't need to be really good, we can buy euro dollar because the euro is showing us its strength. Okay, so that's how we can take advantage of our observation of a previous news event, this time to look at euro dollar. And in the next minor Australian miss, okay, let's say we have Australian retail sales and they come out just a bit under expectations, we have an opportunity here to sell the Australian dollar because we already learned that the Australian dollar is weak. Okay, so I think we tackled this observation of strength and weakness from quite a few angles. Okay, and now let's move a bit deeper into using fundamental analysis, trading the news with technical analysis. Okay, so false breaks, a very painful point. Many traders, those listening now, those watching the recording, like to trade the breakout pattern. What is the breakout pattern? We have a pair, let's say pound dollar, not to talk about euro and the Aussie so much, that is trading in a range. Okay, we're seeing, if we take a recent example, we've seen pound dollar trading between 125.70 to 128.20. Okay, we're seeing this range. Now, let's say that we have a breakout out of this range. Sometimes, not only in the pound dollar, but in many other currencies, this break can be false. Okay, what we would do usually is on the breakout pattern trading is when we have a break, let's say to the upside, we have pound dollar in this example breaking above 128.20 to 128.40, 128.50. Okay, we took the margin, we buy. The idea is to buy higher when we have a breakout and to sell even higher because we have a breakout. We have a breakout of range and now we're expecting the beginning of an uptrend. The other way around is we have a break to the downside. Again, this is just basic technical pattern, not related to fundamental, not yet. We'll soon touch that. We're seeing a breakdown under 125.70. We were selling at 125.50, 125.40 in expectation that from here we'll see a downfall towards the next line of support. So we are selling lower and we are expecting to cover that on much lower ground. Okay, unfortunately many breaks are false. Either there's no follow through, it's just a poke to the downside, scrapping stop loss orders, or it was just too close to our line of support or resistance. And this is quite a frustrating pain point for technical traders. Okay, so yeah, so these false breaks, again, the breakout pattern is quite useful. Just give an example from yesterday. We've seen euro dollar trading in the 111 to 113 range for a very long time, and then we had some positive comments from Mario Draghi, and we've seen the breakout, and now we're at 113.70. Okay, and well, in hindsight, of course, we're all smart. It was a good idea buying it at 113.10, for example, 113.20 after the breakout, and selling it higher. That's the breakout pattern. Buy on a break, sell higher. Well, sell breakdown, and again some breaks are false, okay? Again, but sometimes if we extend this pattern, some of the breaks, again, like we've seen yesterday, we had an initial move above 113, then we had a small retreat to 112.80, and then after an initial false break, we're seeing a real break, the second one, okay? So of course you can say, okay, it's only technical, you have to know where to place the stop loss. So you had an initial move, then if you had a stop loss that is wide enough, you wouldn't hit that stop loss on the downfall, and then you would let it run and it would make a big profit, right? But let's take a look how fundamental analysis can help. Using an example, theoretical one, an important European release, okay? Euro-dollar breaks higher and then retreats back to range. Actually, this is when I prepared this presentation, I didn't know what happened yesterday, but yesterday is about what happened. This is about what happened. We had an important speech from the head of the central bank. We had a break to the upside, and then a retreat back to range. Fake or real? Okay? So we have to try to understand, is the data indeed positive? That is the break to the upside justified? If so, we can expect a follow through. And this is a buy opportunity, okay? Because Draghi was genuinely, for example, yesterday, he was genuinely positive about Eurozone economy, about reflation, about tapering, okay? Is the data negative? This wasn't the case yesterday again, but in this case, this is probably a false break and even a sell opportunity back into the range, okay? So the move to the upside, when it's unjustified, it can provide an opportunity to go to the other direction, okay? And when we look at the other direction, just to have all the parallels here, if euro-dollar breaks to the downside but then bounces back up, okay? Is the data positive? Again, we have to ask this question. If the data is positive, it's probably a false break because the break is not justified, and we can maybe buy the pair and trade it back into the previous range, okay? This is not a breakout pattern, but just a range trade. If the data is negative, then we probably do have the breakout pattern and we can sell it and run with the downfall, run with the short, okay? Another point about false breaks, well, a few caveats, of course. Watch out for the larger trend, okay? Because you know, probably heard the saying, make the trend your friend. If the break is against the trend, maybe it's not that strong. Remember what we talked about before? Remember strength and currency weakness. So you can use the information that you observed with understanding if the currency pair is strong or weak to also analyze if the break is real or false, okay? And you have to look at the data itself. So in the example I gave from yesterday, it was a speech you have to understand what he said, but in cases of indicators it's easier to see. Is it a big surprise? If we talked about example of GDP, if it's 1.2 was the expected number and it came out 1.1 or 1.3, it's not such a big surprise, not such a meaningful event. But if it's a big surprise, a drop to 0.5, a jump to 2%, for example, then it's a meaningful event. Okay, so you have to take these things into account, and it's very important to look out, to be careful with simultaneous releases. In the example we showed before, we had also on the calendar jobless claims at the same time as GDP. We have in many cases Canadian and US trade balance released at the same time. We have other events also happening at the same time, and sometimes it's just too much noise. Even with the same release, okay, retail sales, for example, we have the headline number and core retail sales. If the figures move in different directions, one is a positive surprise, the other is a negative one, then we shouldn't then we should take care, and maybe it's just a mess and it's better to stay out. Okay, and now we reached our fifth and last point. This is something you probably heard as well. Buy the rumor, sell the fact. Let's explain how it is and the exceptions from the rule. First of all, it's a very common pattern in trading the news. It happens with rate decisions, for example, most obvious case. It's very common with political news. So with rate decisions, usually we get the heads up about what's going to happen. And with political news also there are expectations for a specific outcome. Markets are already moving with the expected result. So when an example, for example, with the rate decisions back in March, and also now in June, the Fed basically told us they're going to raise rates, okay? So markets were already moving towards a stronger dollar. With political news, towards the French elections, became quite clear in the second round that Macron will be president. The polls were just showing a huge gap, okay? Then what happens when the news is out? What happens when the Fed does raise rates, or when Macron got elected, or you can find many other examples. The buy the rumor, sell the fact pattern is that the pair goes in the opposite direction. Something that is perceived as positive for the currency results in something negative for the currency, or the other way around. Why? Because markets have already moved in the same direction. So we have take profit. Buy the rumor again, sell the fact. It can be also with negative things. If we're expecting some negative outcome and it happens, markets are already moving against the currency towards the event and then jumping back up. Okay. Yeah, example I already mentioned, euro dollar was rising ahead of the French elections, and then in the second round Emmanuel Macron won, and we had the euro dollar falling because markets were already moving towards 110 if I'm not mistaken at the moment, and then at the time, and then it dropped back down. Okay, that's different from the first round, for example, when there was high uncertainty, nothing was priced in, and when he came out as the first in the list of many candidates there, then the euro did move positively because nothing was priced in. In the second round, we already had the rumor. This case wasn't a rumor, it was opinion polls, and then we had the opposite reaction. When do we have buy the rumor and then buy more? We need an extraordinary figure to come out, okay? We're expecting very good news, and it comes out even better. We're expecting a disaster, and it's a total catastrophe, okay? Then we have an extension. An example of one of the big ones that we had 2 years ago, euro dollar dropped for many months on expectations that the European Central Bank would begin printing money, okay? During the winter of 2014-2015, the euro was falling all the time. And then the news came out in January 2015, and the announcement, the amount of money that the ECB would be buying, and the period of time was even bigger than expected. They would be printing more money. So euro dollar fell even more, okay? So this is sell the rumor, sell the fact in this case of the euro, okay? Buy the rumor, then panic, okay? When we have expectations priced in and they're very one-sided, and we don't get the news that we were expecting, we don't get the fact, we get the other way around, then the surprise can be nasty and we have a big fall. Example, pound dollar went up ahead of the EU referendum, went to from 147 to 150 if I remember correctly, and then we learned that Britain decided to leave the European Union, which was not a result markets were expecting and wanted, and pound dollar crashed, okay? We're still seeing the results so far. So this is another, when we have, again, things are very much one-sided, they can only go to the other way, okay? So making a hypothesis here about Brexit, for example, the pound was going up on the expectation that Britain will stay in the EU. If this would have been the outcome, probably you would see a buy the rumor, sell the fact. And as this wasn't what happened, the pound fell anyway because it was bad news. Okay, so when everybody's going in one direction, there is more risk that we will see a bounce move to the other side. Okay, the risk was just one-sided. Okay, so these are the 5 points about trading the news. Maybe we'll do just a very, very quick summary. So we have to understand how fundamental analysis works in general. When things are looking good, a currency strengthens and expectations that the central bank will raise rates, and the other way around. Then we discussed what is priced in. You have to look at what's important in the economic calendars, understand if we have a positive surprise, a negative surprise, okay? And if these expectations have already changed by looking at events that feed into the main event, in some cases, or on price action just before the release. Okay, then we talked about strength and weakness of currencies. You can observe the reaction to an event to understand which currencies are strong, which are weak. We can use it in various ways. And we discussed false breaks, a very painful point, and try to understand using fundamental analysis when a breakout is real. And even if we had a retreat, it can be followed by another one. And when the breakout is false, we have an opportunity to trade it back within the range. And finally, we talked about buy the rumor, sell the fact, about a one-sided risk usually in political events, rate decisions. When everybody is going to one direction, there is little chance that we'll have an extension. Again, there are exceptions. We mentioned one, but in general, there is more risk that the currency pair will just go to the other side. Okay, so again, thank you very much. Comments and feedback are welcome. Beginning from next week, we'll begin talking about specific currency pairs more in detail about how to trade them, the fundamentals, the characteristics, also technicals as we touched today. And that's it. So thank you very much to OctaFX. Thank you very much for watching. I wish everybody success in the markets, and we'll see you soon. Thank you very much. Bye bye.